Hey guys, let's continue with the Supreme Court ruling on Michael and the Thomas Connelly case. We have been talking about basically we're praising the Supreme Court on the valuation part. Okay, we think they did a good job, and however, the taxation part we have some. That's where the problem is. There are a few problems. The first one is that the Supreme Court itself, okay, why I said it did a good job, it very detailed thinking, very thoughtful on the valuation. It is totally right to put the you know life insurance death payment lump sum as part of a valuation, fair market value for the corporation. But it doesn't say anything, not a single word, on the fact that the IRS charged additional 900, almost $900,000 taxes for the estate taxes. Okay, so this is the difference. The IRS basically said, okay, your death benefit, it's not, we're not taxing on that, on your death benefit. Okay, but because your death benefit increased your corporate fair market value, and Michael is one of the two major shareholders. He owns almost 78% of the shares of the Francie Supply Company. That's the name of the Michael Brothers company. Okay, he owns 78%, almost 78%. So IIS basically says that because you're the owner of uh, the, uh, the closely held company, your value, your estate value increased because by adding the key person's KPI death benefit to the part of the company's value. And then you are the one of the two owner of the company. Your estate value also increased. Because of that, we're going to charge you the estate taxes. Okay, so basically, this is like in the highways, you're driving and the cop stops you, and the cop came walking to you saying, "Hey, we're gonna give you a ticket, not because of DUI, because we tested you're not drunk, but we will give you a ticket for reckless driving, and the same amount." Okay, so that's got a different name, but the same amount. So the fact is that IIS and the Supreme Court basically are charging the Michael's estate additional $900,000. That's almost like a 40% of the additional money, additional death benefit payment. It's basically $3 million from the KPI policies. Okay, and then originally Michael Connelly's estate was obviously, according to IIS, significantly under estimated the estate value, fair market value for the estate. Now with the 3 million death benefit coming in, indirectly increase your estate money. Then the estate, the IIS will charge you against that increased value. That's almost 40%. Okay, like I said. So this is a same story, but we take a detour, with a different name, but the end result is the same. We get penalized, especially consider that the premium for the KPI policy is paid with after tax, post tax money. So that's a double taxation, if you will. Yeah. But the key point is that it's not this. I guess the problem, the key point with that the Supreme Court ruling is that it basically said one word, not a single word on the IRS charging $800,000, very close to $800,000 additional taxes, and didn't say anything. But if you think about this, that's another part of it. It's the Thomas Connelly's legal team. They did a lousy job. They didn't raise the issue because if you think about this, um, even though the IRS is charging taxes based on estate value, fair market value of estate, but if you think about this, estate taxes has a very much higher threshold, much higher exemption value than income taxes. So if you took a looking back, the Michael Connelly died in 2013. If you look back, because everything's transparent, you can check out what's the threshold, basically exemption value. You know, below that exemption value, you pay zero estate tax. But above that value, above that threshold, you pay the whatever is above that threshold. Okay. So what is the threshold for 2013? That's open information. You can check it. I think it's in for 2018. The threshold, the exemption value threshold is $5.25 million in 2013. So how much is that Michael's estate value above that? It's about, basically if you take that cut off that threshold value, Michael should only pay less than $18,000 instead of almost $900,000 the IRS charging. So there's a couple issues. Number one, IRS did not do the. There's no. We don't know what happened, but obviously, in the eyes of IRS, that's how much Michael should owe the federal tax for the entire value of more than $6.28 million for the entire Crown C supply. But because Michael holds only 78%, so it comes down to $5.28 million. That is due. So IRS think that the entire $5.28 million is taxable because for the estate taxes. Okay, but IRS didn't say anything about the exemption value. Remember that the 2018 the exemption value for the one single individual is $5.25 million. But assume that Michael is married, the couple will be double that, will be more than 10 million, $10.5 million. That's totally exempted. So, but in Michael's case, he is, according to IRS, he owns the, his estate value is like $5.28 million. And then that whole thing is taxable according to IRS. IRS says nothing. But the IRS may not have the duty to say that, well, to remind taxpayer that part of it is exempted. But the Thomas Connelly's legal team didn't make any one point on that. They should have, the whole thing should have dropped. They don't have to, instead of spending money and time to go all the way up to the Supreme Court, the Connelly brothers, the estate, can just pay a little thing, less than $18,000, and that's it. The whole thing should be settled without going to the court. So the whole thing is a multiple parties problem. Okay.